Hi, I'm Steve Van Metre, and welcome to your weekly economic update, where we take about 30 minutes every Friday to take a deeper dive into what's going on in the economy and the charts and see if we can make sense of it all. And things are getting really interesting. Now, I thought, and you'll see this if you're reading the written part first, we'll kind of just follow up on that. And if you're not, when you read that, you'll see that this is kind of what I thought was going to happen last quarter, where we had this setup where the bond market was looking like the yields were just going to tank. It was going to pull liquidity out of the equity market, but instead the corporations just hit the pedal to the metal and bought because they're panicking ahead of their first quarter earnings. And when you understand what is going to happen, we already know, and we looked at it Monday, we'll kind of just take a brief look at it again today, is that earnings for the first quarter back in December were expected to be really good. Now they're expected to be bad. Now, how do you fix that if you're a corporation, right? You want to keep your stock price elevated. And yes, you can borrow money or you can take your free cash flow and buy stocks, but there's an easier way to do it. You need to reduce the number of shares. So let's say your earnings are dropping. Well, then you need to reduce the number of shares so your earnings per share works out to whatever analysts on Wall Street expect it to be. The problem is earnings are going down quite a bit. And that means you got to buy a lot of stock back, a lot. And the question is, will they have gotten enough? Don't know. But we do know is FedEx reported earlier this week, FedEx is a great barometer of the global economy because they are a proxy for air shipment. Now, we've looked at container shipment in the Baltic Dry Index over the last few weeks or so. But FedEx is your air shipper. And when they start saying things are bad, yeah, things are bad. And then we saw Micron, which is a company that makes random access memory, or at least that's what they're best known for. They came out and said, well, we're cutting production by 5% because we have record inventory, but don't worry, we're pretty sure that inventory is going to go away really soon. No, not likely. So when you start to see some earnings come out and you go like, wait a minute, we have inventories building or shipping slowing, that's not good. And FedEx is, for the most part, if you look at what they said, they are effectively saying we are headed into a global recession based on their data alone. So it's getting really interesting what's going on. But before we get too deep into all this, the content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by selling security, financial instrument, or to participate in any particular trading strategy. This video is prepared by Steven Van Metre, own personal capacity. Opinion expressed in the video that do not reflect the view of Atlas Financial Advisors, Inc. or Steven Van Metre Financial. So why this gets interesting is the stock market's up and high based on the notion that there's this perpetual earnings expansion, which never occurs when you have monetary decelerations triggered by the Fed tightening monetary policy. Now, I know Fed's going to back off, but they're not backing off just yet. So they're still in full force for the moment. But what we expected and what we're starting to see is interest rates go down. And because there's so many people shorting U.S. Treasury bonds and using that cash to buy stocks to boost stock prices, that as interest rates go down, those people are forced to come out of their short positions. They either need to cover them by buying bonds, or they need to exit them, which is the equivalent of buying them. And if they don't have any money or enough money, they have to sell stocks. And you go start selling stocks, well, that causes volatility to rise. Well, volatility is going to start rising because corporations who have been buying their shares back aren't buying back as many because they can't during the blackout period. It's just how the design of the system is meant to work. So you have volatility starting to rise. Well, the same people that were buying stocks were shorting volatility to get stock prices up higher. Well, if volatility rises, they need to cover their volatility shorts by either buying volatility or the effect of buying it by exiting their short volatility positions, which then in turn cause stock prices to go down, interest rates to go down, and you start to build again this feedback loop. Now, at some point, we're going to get a big purge, as I've been predicting for a while in the market, and that's going to be really interesting. And whether it's this quarter or next quarter, it's going to happen, but it's looking like it's going to happen now, because what we're seeing is inverted yield curves, where you find that the 3-month Treasury bond is inflation adjusted is higher than 10-year yields, and that is not normal. You want shorter term yields here, longer term yields up here. You don't want them reversed, because when that happens, banks who borrow at short term rates and lend at long-term rates find themselves being unable to loan money out, because why would they borrow money at a higher interest rate that they can get if short-term rates are higher than long-term? It doesn't make any sense. And that's why all of a sudden banks tighten up lending standards. They stop loaning out as much money. And that, of course, already hurts an economy that is in the midst of a monetary deceleration. So what are the banks doing? Well, they're buying U.S. Treasury bonds to hedge this. Lo and behold, the smartest people in the country in terms of access to information are buying bonds. So what does that tell you? You ought to look at is the bond market. And that's what our focus is, of course, going to be today, because we want to take a look at the bond market. But let's go ahead and jump into the rest of the charts, wherever they are. There we go. Now, some of these were not updated, so we're going to omit them for this week, but we'll catch back up on them next week when hopefully the Fed gets, I don't know, they just didn't release the data fast enough. M2 money supply versus recessions were just hovering right around this 4.1%. It should say up slightly, but it's negligible. The 6-month rate of change increased a little bit. The 3-month rate of change is flat. The money supply did grow by a mere $8 billion, but you can see the trend is rolling over, and it is not in a good place. Again, right above the doomsday line of 3.7, but at 4.1, the economy is not generating enough money to cover all of the debt. It's just not doing it. Looking at the Federal Reserve balance sheet, now later this year, we'll probably stop looking at this chart, but for the moment, they dropped $9 billion, and they're now officially under the $4 trillion mark. They are going to quit this program later this year, but you'll notice they're not bailing out stock market at all. There's no signs of it in this unwind. And we looked at this on Monday, but for those of you who missed that update, I do want to kind of touch on this. This is earnings growth based on data from FactSet. We see down here what it is today as of whenever they made this chart, and then December 31st. So you can see in December 31st, there's all these positive numbers for the most part across most of the sectors. But as of today, all the positive numbers have been reduced, and you can see financials are negative, communication services negative, the broad S&P is going to be negative, consumer staples, consumer discretionary, information technology, who are the big buyers of their stock, they don't black out for another week or so. We'll look at that. They're going to show negative numbers. Materials, you see a lot of mining type companies in here, negative. Energy sector, biggest potential for doubling in December. You see a double-digit EPS to negative. So keep this in mind when we kind of look at the chart. Looking at the buyback blackout timing across S&P 500 companies, 75% of companies will start blacking out by 3/19. So that has happened this week. And you can see kind of this is really going into next week where you really get into the peak blackout, where you see firm after firm, or sector after sector, is really high in the percentages here. So you see dividend, financials, energy, 100%, food and beverage, 100% blackout. So they will not be buying stock back or very much of it next week. Technology companies, which again, companies like Apple, big buyers of stock, they don't fully black out until a couple more weeks from now. But you can see software, semiconductors, those come a little bit later. So we should see things dial way down on the market. And you can see the blackout period does run through or kind of mid-late April, but most of the companies are in blackout by this time next month, and then that starts to fade. So keep this in mind as you think about what is coming for the stock market. We looked at this on Monday. Again, the Federal Reserve unwound this week, which doesn't show up in the data till next week, $9 billion in mortgage-backed securities. They're going to do another roughly $9 billion next week, followed by $22 billion in Treasuries the following week, in a period where there is not much liquidity. So this makes things more interesting as the Fed is still tightening into an illiquid period. And looking at the quant CTA models, this was going back a couple of days, but you can see levels on the S&P 500 that have breached. The quant models will go from 100% equities and start selling S&P 500 futures, and they will continue selling as the market goes down. So again, you have really high positioning at a point of illiquidity. Now, this was a pretty neat chart that was published by the Wall Street Journal and Daily Shot. Global equities return and earnings revision ratio between 2014 and 19 versus return. So return being essentially the S&P 500. So you can see that global equity and earnings revision ratio is headed down back to the 2016 lows. And guess what? The stock market hasn't figured that out yet, but it's likely going to figure it out pretty soon. Again, makes this very, very interesting. As I've said, I'd like to see the market break these December lows here, but this is telling us that we could get back to where it was in 2016, which I think we will. Looking at US GDP growth versus FedEx, and you can see that with a 9-month lag, using log percentage change, and you can see FedEx leads US GDP growth, and FedEx is saying GDP is headed, negative. Well, not negative, down to close to zero. And based on the Atlanta and New York Fed projection models, we already know that's coming, and those usually project a little high. So FedEx is already telling us we're headed toward a global recession, and things are about to get much, much worse. And as far as corporate buybacks, we can see that the quarterly average of buybacks was rising, but the 4-week average is falling. So the big money executives who've been cashing out are almost done. And maybe this is the last straw for them as we end. We'll kind of get some more information on that during the first quarter earnings, I imagine, of terms of what companies are planning to do with their buybacks. But we can see that insiders are just about done selling, as we normally see that they do. And so that means they must think some bad news is coming. Looking at the regional banking ETF, this is symbol KRE, and versus the S&P 500. And you can see these two have a very nice symbiotic relationship, which is suggesting that the S&P 500 is going much lower. We'll look at a different version of this chart on my trading platform when we get there, but it's certainly interesting to see this disconnect is going to reconnect. And global money supply still too low for comfort. This was by Macrobond and Noria, and what they're saying is the global money supply on a year-over-year basis leads by 12 months the S&P 500 price return, saying that the S&P 500 is going down, way down compared to where it is now. It's going to head much, much lower. So that's kind of some interesting charts for the week. Let's go and look at, while we're on chart mode, let me find the browser, flip over there, and I'll get things set up for what we need to see. So let's go and look at asset and liabilities of central banks. This is a Fed H.8 release. You can go to the Federal Reserve website and find it there. I've already kind of got it loaded up, but you can see banks are buying bonds. They bought $10 billion of U.S. Treasuries the week before last, $5 billion of mortgage-backed securities, and about $4 billion of non-mortgage-backed securities. So again, the banks continue to buy bonds. And all that means as investors is what the big banks are doing. Well, you ought to be thinking that they know way more than we do, way more. So if they're buying bonds, they're hedging against downside risk. They're also buying bonds because they have nothing else to do with their money. And that tells us where the bond market is likely going. So let's take a look at the charts, as we normally like to do here. We'll start with the S&P 500 in this massive topping pattern that looked like it was going to break out this past week here, out of this resistance zone, and today came crushing right back down into the middle of it. So at the moment, resistance is still resistance. We're still looking at a potential 1, 2, 3, 4, 5 top pattern, not counting all this over here. So we know where the big players have been selling. They're selling right in here. We'll see how this plays out. Looking at volatility, the VIX index closed right under its 200-day moving average. And you can kind of see that when the VIX is under its 200-day moving average, volatility is kind of like a genie in a bottle. It just gets contained. But when it starts getting over its 200-day moving average, it starts to take off. And a big volatility spike at this point would just rip the markets apart. And you can see the volatility is trying to rise. Now, when we look at the ETF, which you should never trade, ever, unless you read every word of the prospectus, and then when you find out you can lose all your money, you should still not buy it. But you can see that volatility came down and hit its support zone here, kind of broke through 1 and 2 zones, but now it's down here where it was before, and there's a lot of volume here, a lot of volatility hedging today as the stock market went down. And that's something I may write about this next coming week. But anyways, if volatility can get going, I have a hunch that it's going to break this $50 to $52 level. Where it goes, I don't know exactly, but it's going to unwind the market if volatility gets out of its box. And at some point, it will, just due to the Fed. Now, I want to point out on this S&P 500 chart that you have a left shoulder, a head, and a nearly identical matching right shoulder. So now you have, at the moment, what looks like a 15-month head and shoulders pattern that, if broken, would send stock prices considerably lower. And what that tells us is, if this pattern is valid and it holds out, that 15-month-long head and shoulder reversal patterns are extremely, extremely rare, to the point where you're talking all the big money guys are getting out, leaving the market to fend for itself. Yikes. That's why when we look at those other charts where it says we're headed back to 2016 levels, there's a lot of information that says, yeah, that's a likely destination of what's coming on. And it'll be very interesting, because those who are stuck in the market will be forced to hedge, and that triggers massive rebounds, right? Think about this. Let's say you can't get out of the market. You've got your positions are too big and it's crashing. Now, obviously, you don't want to tell your clients you lost, 30% of their money. So what you do is you start hedging. You short your book. Essentially, you look at your holdings. You start shorting the stocks that you own. You short the broad market, or you buy volatility. You do all of the above. And when you do that and the stock prices come down, at some point you unload those short positions, your hedges. You cash in some of your gains to offset some of your losses, and that causes stock prices to do one of these. Now, we got a preview of this back starting in December, and that is this move right here. So this is something you see in bear markets. The next one will be much bigger and have so it'll fall deeper and it will have a much larger rebound. That's where you really get interested in this, because you never know what's going on until you start to see the pattern play out. But 15 months of stock prices not rising, you can see they're nowhere better than they were in January. So when you're in a 15-month pattern, the odds of this being a bullish position against all the other data, not valid. But in a bearish position, it tells you stock prices are going considerably lower. Let's take a look at the bond market. Again, everyone thought interest rates were heading to the moon, and I said, nope, this is all just one big topping pattern. The big money's buying, the banks are buying, and sure enough, look what happened. Yields gapped down. Now, this is very interesting. When you have gaps, there are two types of them. You get the gaps at the beginning of a move or in the middle. So you have a gap here, and we have a gap here. And all this is telling us is this move is continuing. Right now, there's nothing slowing it down. So why does this gap? Because in overnight trading, there were way more buyers than there were sellers, and that caused interest rates to fall. Now, you can see during trading today, and we'll zoom in, that people shorted in bonds to try to get some ammunition to buy stocks to hold their stock positions. But you'll notice it held this dotted line. Now, I didn't move that. I know it would be cool if I cheated and did it, no one would know, but you can go back and look at old videos and see I didn't budget one move at all, and it came back, and right now this would be support. So support is acting like resistance, again, telling us that at least for the moment, 10-year Treasury yields are more likely to head back down to 2.3, and then from there, let's zoom out. What happens at 2.3? You've got all the way potential now to hit the pre-election levels, no problem. And there's still a lot of people that are short, all right in here. There's all kinds of short interest. They've not backed out of much of it yet. As this keeps going, they will, because once it breaks this 2.3, you'll notice it's got a quick move down here, but it's not going to hold. It's going to get quickly down to 1.9 if it can breach through here, and it will. The banks are buying. And looking at the 30-year bond, we see the same gap here, confirming that this move was valid, and now we're gapping out of a consolidation move. So again, we should see lower Treasury yields here on the 30-year, and once it breaks through this level here around 2.7, you're back to pre-election levels at 2.5 pretty quick. And now at face value, you think, oh, lower interest rates are good. Yeah, they do. They take pressure off the economy. We saw that in the housing data today. Existing home sales increased because prices on homes went down and interest rates went down and allowed some people to buy. So from one standpoint, that means low interest rates are good. From the stock market perspective, you get tighter liquidity conditions because all these people that are short these Treasury bonds have to get out. And that's one of the things about leverage when you buy the U.S. market is leverage cuts both ways. And sometimes it's in your favor. And as quickly as it became in your favor, it can cut the other direction. So that's what we're starting to see now, and we'll see more of. In fact, we can overlay The S&P 500 here, where is it? And we'll zoom, and you can see Treasury yields are again saying that the S&P 500 needs to be much, much, much lower. In fact, we'll look at that regional banking ETF, and you can see here, let's zoom this thing out. Out would be this way. You can see they trade pretty consistently together, and you can see regional banks are falling, again telling us that the S&P 500 should be somewhere around 2,400, and regional banks, if they don't hold here, are going to go visit their December lows. If they don't hold that, watch out below. They're going to completely crush down to their 2016 levels in a heartbeat, and that's going to pull the broad equity market lower, 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 lower. So we see this very interesting setup as the corporate share buyback blackouts go into full effect. Let's take a look at oil and gas producers. There they are. Now this was starting to look bullish, and people were starting to talk about, oh, it's holding over its 50-day. It just closed over its 100-day. This is bullish, bullish, bullish. And I'm like, no. In fact, I want to show you something now that I'm thinking about it. Let's go back here and look at 10-year Treasury yields. So notice how yields came down, and then they consolidated, and then they tanked. All right. This period here was consolidating to continue the trend. This wasn't a bottom in yield. This was just a consolidation point, and generally consolidation means the direction you started is the direction you're going until a bottom is set. Now let's look at oil and gas producers. Big drop. So they went a little farther than the market thought, rallied back, consolidate. And now people think they're consolidating the upside. The reality is the bottom hasn't been confirmed. They're more likely to head lower than they are higher. And what happened today? Rejected the 100-day moving average, rejected the 50-day moving average, and are now sitting on pretty strong volume just over their support channel right here. And why do these consolidation periods happen? So the big money that's sold in here kind of will push prices up a little bit, get other people to buy in so they can sell. And then once all the selling is done and the buyers are tapped out, prices fall, and then the people, the smart money that sold all this, come back in at some much lower point and cash in a big way. So we see that same trend in oil and gas producers that we see in U.S. Treasury yields. In fact, let's just for fun, let's just overlay the two. I didn't do this earlier, but there you go. You'll notice there's a lot of similarities here. So as one broke down, the other broke down. But look, Treasury yields are telling us that we've got a retest of the December lows in oil and gas stocks. And guess what? Treasury yields are headed even lower. So very, very interesting stuff going on in the markets here. Let's take a look at gold that I still think is coming back down into one of these two levels. It's fighting. This is a bearish flag pattern that's kind of forming. Again, I think we got 1240, 1250 right in here, maybe down to 1200. Some other experts are saying that this is going to go down here. Either way, once the short-term move is over, the long-term move comes into play. That's what I think is going on. When we look at the mining stocks, we see a very similar trading pattern. It's just getting stuck up here in resistance. That'll should you send it down into here, or perhaps into this $19 range. Let's take a look at silver. I didn't look at that either. There's a similar pattern there. So for the moment, something's going to unwind as we get into this blackout period and volatility spikes, and I'm not leaving the gold miners off the list of things that are going to get hit along with everything else. Look at emerging markets. See, they've dropped down to their 50-day. They need to come down to one of these two purple bands. You get a triple bottom here. That gets really interesting. I've watched a couple interviews with some technical traders last couple of days on emerging markets, and they were both signaling independently this $39 to $40 range. So they think from a technical perspective, it's getting down here, which would mean then the dollar is going to roll over at some point. And let's look at the dollar. It kind of came up and it's just been holding along here. Now, some people say there's going to be one big shoot to the dollar. It's going to really hurt the economy, and then it's going to give up some of its strength. That could happen. But for the moment, the dollar is confirming its 200-day moving average. That is a bullish trend until otherwise spoken. But it's still at this resistance channel with its two dotted lines between 96.50 and 97. It's just holding really strong. That's a little over 96.50, but nevertheless, this has been holding strong, but we get a move up into the high 90s, and you're going to watch financial conditions rapidly tighten. Let's take a look at the 7 to 10 year Treasury bonds. We can see we got that gap up and go, consolidation, come out of that with a gap up. This thing is headed up to the 108, 109 area, and then from there we can zoom out. If it breaches that, it's got every shot at back near its all-time highs. I mean, there won't be much holding it back, but there's a lot of short interest still in here. And if you think all these people that were shorting in here have covered yet, they haven't. Not even close. There's a lot of short interest going on here. And remember, not long ago, everyone said this thing was headed to zero. No, this is just a big bottoming pattern that's going to flush its way out to all-time highs. Looking at the long bond, the 20-year plus Treasury ETF, again, consolidation, gap up, consolidation, gap up. We know this thing's going to shoot up here to 128, 129, and it's going to run some resistance. If it get through there, boom, this thing's on its way up, 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 and up. And let's take a look at the last symbol I want to look at, little ag commodities. Today they were fighting a war which over the 50-day moving average. Volume was elevated, but notice how it all came. There's some heavy selling at close, but what we see is people were obviously absorbing into that because a lot of volume, a lot of buyers, a lot of sellers. It came down, but it didn't go down that much. But we see this nice trend starting here. We see the first move up, a little consolidation, second move. So we'll like to see this trend continue. But as I've written about, Nebraska's pretty much underwater. Not the entire state, but they're pretty much underwater. And a lot of the growing region is massively flooded. We're seeing record flooding. And from a little bits of that I've heard, and you have to keep this in mind, the Department of Agriculture they don't report data right now. There's just a time of the year they just don't. Nothing to do with shutdown, they just don't. On the ground reports say 1/3 of stored corn. Now remember, there's been all this talk about how U.S. farmers are just overwhelmed in inventory. Based on some data, I saw 1/3 of corn and I think soybean supply as well is underwater. Obviously, that's not going to get sold. It's junk. And the problem they're having there is they got this huge snowfall, right? Then they got the bomb cyclone or whatever they're calling it. It dumped a whole bunch of rain and flooded. Now that snow's starting to melt. They're getting more rain coming through, which they really don't need right now. And as the flood waters recede, they're going to pull topsoil with it. They're going to pull small farm animals with it. And they're going to knock over buildings, take equipment, and damage even more stored crops. And so everyone's like so negative on agricultural commodities at a time of the 11-year cycle. You should be super bullish about it because one of the challenges that farmers are going to have to do between April and May is they have to plant. They have to plant if they're going to. And you can't plant in mud. It doesn't work. I mean, hybrid crops today are very specifically designed to be planted in a specific type of soil condition, under specific weather, to be in the ground for a specific period of time, plus or minus, we're talking within like a week. They're designed to have a very expected type of sunlight, certain amount of rain. It's all built into these hybrid seeds. They're just so genetically engineered. It's down to ideal conditions. When you get ideal conditions, you get massive yield. But when you have unideal conditions, it doesn't work. And that's why during these every 11-year cycles, not only do you get these wonky weather patterns that change everything, but in modern day, we have these hybrid crops that just don't grow well. So farmers cannot plant in wet conditions. I mean, they can. They're just not going to get much out of it. And based on right now, they certainly can't plant because they're underwater, literally. So I know a lot of people are bearish about this sector, but the weather conditions are telling us very clearly this is the beginning of what we always have seen is these cycles 11 years ago. 2007, 2008. Where are we? 2018, 2019. You see all of a sudden, boom, because you get these adverse weather conditions that damage crops, get rid of inventory, whatever. Well, look at down here. You've got this is one of the most shorted sectors in the economy. So when this starts to move higher, not only do you have just the seasonality going higher, you've got short sellers to plunge out. So what we would like to see is a move somewhere between up in this range in here is what we'd like to see crop prices get up to. And when that happens, it will be the death knell to the U.S. consumer because the only thing that's keeping the U.S. consumer intact right now is cheap food prices, and they're not spending much money at the grocery stores. There's just not a lot of data showing consumers are spending much on food. But when crop prices go up, when you have a tight economy and higher interest rates, I mean, not historically high, but high from zero. Consumers tap out. That's it. Done. Game over. So I'm Steve Van Metre. That's our update for the week. Thanks for joining us. We'll be back hopefully on Monday to see what's going on. I look forward to having you join us then. Have a great weekend. Bye now.